Julie, as you know, the markets are mixed today with the Dow trading higher, but the S&P 500 and NASDAQ, they're edging lower here. Where do we go from here, though? Well, our next guest says the SPX has started its trek back to late March highs and should exceed this en route to 5,400. For more, we're bringing in the one and only Mark Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Mark, great to have you on set.
Thanks, Josh. Great to be
So
here.
we were talking off camera, Mark, just about, it is interesting, I mean, today to see how some of the big, really well-loved names like Uber getting nailed today, but I want to start kind of broader with you. You look at the SPX, the S&P 500, when you're looking at the charts, what are the technicals telling you, Mark, about where we're headed near intermediate term here?
I think it's important to keep in mind that we've seen an amazing first half of the year thus far with very little overall volatility outside of just really 3 weeks that we saw from late March into mid-April. It's been far less volatile, I think, than most years at this time. But it fits right in with the seasonal playbook of election years, which says we do usually get some sort of a first, second quarter pullback, and then we go literally straight up into the fall before some consolidation ahead of the U.S. election, and thereafter we go higher. I would note that we've seen a lot of rotation. It started off being technology, industrials, energy, and then that faded, and we saw more movement into materials, and literally in the last week, a little bit of evidence of healthcare bottoming out, and so that's interesting. To me, this is actually quite healthy. Technology has not deteriorated enough to think that you would avoid it, even though it's been down, really since late March. That sector has started to stabilize. Stocks like Apple have broken out, which are extremely important to the broader market. So I'm actually pretty encouraged at a time when sentiment has grown a little bit more negative. At a couple pieces of information that say the economy might be slowly starting to stall a little bit. ISM numbers were lower, jobs. So that's actually taken rates back to the downside. So at this point, it's really bad news is good news for the stock market. As rates and the dollar start to move lower, that's a very good sign for U.S. stocks in the short run, and they'll push higher.
Yeah, we definitely saw that on Friday with the jobs report, for example. There was a lot of conversation really in the beginning of the year about the rally broadening out, right, beyond technology. And you highlighted in a recent note, looking at that S&P equal weight index, that we're seeing some positive signs there. And this is an interpretation of the chart that you were looking at.
What's interesting was we've now seen breakouts in the RSP, which is Invesco's equal weighted, and it's still nowhere near prior highs, but the fact that it's breaking out, we're seeing now some evidence of small caps and also mid caps, starting to gain traction. I think that's very, very important. Many are still hyper-focused on large cap technology, but it's important to note that, the S&P was up 10% in the first quarter, while healthcare and stocks like Apple actually were down. And so now those are both starting to stabilize and turn higher. So if we can get that movement in healthcare, which is the second largest sector within the S&P, financials, seeing a little bit of boost in technology as rates turn lower and we see more of a push back towards growth. That's going to be very, very good for investors. So I think this is a year for risk taking. I'm very bullish. I think we push up to probably 5,400 at a minimum. We can see consolidation, I think, in the fall, but now is not a time to be running for cover. If anything, with evidence of treasuries starting to gain some traction and yields are starting to roll over and the dollar is starting to pull back, that's been great for emerging markets. We've seen areas like transportation coming back, and that's very, very good. As a leading sector along with semiconductors, both of them are very good for the market.
You touched on where I want to go, semis, because you got ARM reporting after the bell, Mark. I'm just interested when you look at the chips, the semis, what do you see?
The stocks, it did have a pretty severe pullback over the last few weeks, but we have come back. I mean, we've moved up 4% or so at least within just a few days' time. We've seen nice movement out of Nvidia, some of the leading stocks within the semiconductor space. Obviously, still stocks like Intel remain laggards, but the majority of the space is still in great shape, and it's still my favorite part of technology. So my thinking is the stocks gets back to 5,200. I'm still optimistic that we're going to push higher.
Well, and from a fundamental perspective, we still have a potential catalyst coming later this month with Nvidia earnings on the 22nd. So is that going to be the thing maybe that's going to help it push up?
It's already started to push up. I think that will certainly help to the trend to probably accelerate. So I see Nvidia getting back to its former peaks, which is near 975, I think, and above that, it can really push up to right near 1100. So I like and I'm long Nvidia. I think it's going to continue to work.
I want to switch gears a bit here, Mark. I'm very interested in your take on oil, because we're around 79 here. A month ago we were above 85. Right. What do you see ahead?
I think oil does have the potential of rallying. We did see a pretty sharp drawdown but in April for crude, and now it seems to have hit an area that's technically trendline support, and we're hearing evidence of now Saudi Aramco is raising prices to the shipments to the Far East. I think that's a very good sign. There's going to be pressure, obviously, in the back half of the year, I believe, from the administration. The U.S. will continue to pump a lot of crude and evidence to keep crude down, to keep inflation down. That's something to be aware of. But for right now, I don't see any evidence of demand waning. As China starts to come back, that's something that, at least from a perception standpoint, means that there's going to be demand for crude, and oil should push higher. They've extended these output cuts, over the next, at least through the second quarter and likely into the third quarter. I think that's really, really going to be good for crude. Seasonally speaking, we're still in a bullish time. That's going to change in the back half of the year. For now, I think we have a decent bounce back to the high 80s, 90. I think energy can still work, and it's still an overweight for me as a sector.
Interesting, up to 90. Not good news for drivers, I guess, in the U.S., but good news for those who are long oil. Dig into healthcare a little bit more for me, because I know specifically you've been looking at the XBI biotechs. So what are they telling us about what we're going to see in healthcare?
Healthcare has been affected by a lot of different factors. I would just say that XBI is a small to micro cap type ETF as part of playing biotechnology. So as rates start to pull back, which is my expectation, I think honestly under 435 in the 10-year could get us down under 4% and even down towards the mid threes, which would be that either means economic weakness is coming, but my cycles say that rates are really going to start to plummet, and that actually is going to be a source of a positivity for small caps, XBI being something that should start to recover. Healthcare has a very seasonally bullish time of the year, which normally is June, July. So the sector has been battered, and now it's starting to show evidence of bottoming. Stocks like Biogen, stocks like Vertex today having a very good day. I think the sector makes a lot of sense for those that wish to be tactical and play for a rally over the next 3 months.
Before I let you go, I got to pick up on one thing I heard you say there, 435 on the 10-year. How far do you think we are from that? When do you think we would fall to that level?
Well, we're getting closer.
Yeah.
The 10-year in Germany, the Bunds almost broke down in yields, and I think we're very, very close, and I think it happens over the next few weeks. And so, the evidence, the quarterly refunding, I think was a tipping point for treasuries, along with evidence of a little bit of economic weakness. 435 lines up with a couple different former highs over the last few months. Breaking that structurally would be a negative for yields. I think we probably get down to 3.5, which is a big, big move before we turn back higher. But it is going to prove to be a sign of relief for those trying to refinance, for those who are looking to buy homes. The housing sector in general has held up with this unusual sign of the U.S. consumer locking in rates at 3% and then not wanting to refinance. So there's an undersupply of homes that has sort of artificially maybe kept the economy afloat, and U.S. consumers have been insulated from those interest rate hikes, specifically given that they're all locked in at low rates.
Well, certainly the rates heading lower would provide some relief there. Thanks a lot, Mark. Good to see you.
My pleasure. You too, Julie.
Appreciate it.